Of the 14, we picked, let me just kind of recap here so you know exactly, apartments, townhomes, college apartments, acreage of land, or 7, including a hotel. Okay, so 7 assets of the 14, which we represented the acquisition of basically 7, which is 50% of the collateral. Okay? So with that said, this is what's really unique. Though we have an expert in the field who is responsible for doing the due diligence and negotiation, and he has the bandwidth to deal with these kind of assets, what we actually ended up doing was we hired a third-party company to do the actual valuation of the assets, to actually do the underwriting of the transaction. And as we started diving in, we actually got a full estimated breakdown of the total amount of assets. Here's what's interesting. It was once 140 million euros. At the time of the appraisal, the assets came in at a total of 53 million euros. Okay, so you can just imagine what a huge value drop that was. Okay, so with our part, what we actually were looking to take out of this particular portfolio represented a total value of 39 million euros. So this was basically our box, our true value. Even though this sounds pretty and this was huge, the reality is we needed to know what is today's valuation, not just based on the value of the asset, but what is the income that is generating. So when we broke down all of the income stream from these particular collateral components, and we had the company actually do the research, we found out that the total net operating income of this particular asset, or these particular assets, I should say, was generating a total of 2,326,000 euros a year. And actually, to be exact, 280. Okay? So, from this standpoint, we now started gauging in our research that the current valuation in the marketplace for the portfolio that our team and our group was interested in was a total of 39 million euros. The net operating income of those income-producing assets was still performing at 2 million and change. And so therefore, we were able to look at this, though some of it was land, some of it was development, we were actually able to look at this from the standpoint of an income-producing investment portfolio. And so I can tell you later about the unique things that, the brilliance of our team. I mean, I've got to really hand it out to them of how they subdivided this project and ultimately generated some amazing restructuring of the project. But from a standpoint here, what we were able to do is then work with them as a U.S. company going in to become one of the investors in acquiring this particular portfolio. And as a note buyer, we were able to negotiate our share of the collateral that they once had down to 14,500,000 euros, which is basically almost half or below the valuation. So we're standing in here getting this paper for a fraction of the original value for sure, but also well below the true valuation of the current analysis that we've done. So if you were to take down exactly what we bought it for and you divide it by the income stream here, and take the NOI, divided by the actual purchase price that we were getting this project for, you're still dealing with a 15% annualized return.